moving ahead, ladies and gentlemen, it is very well said, know what you own and know why you own it. So on that note, it's time for a basic overview of alternative investments, how far they have come, the whys and whats of their market trends, and a closer look at the description of alternative asset classes, explanation on alternative investment strategies, and a description of the various vehicles used for alternative assets and the strategies that they may be accessed with. So therefore, without much ado, I would like to make way for our first panel discussion on the ABCs of alternative asset strategies and vehicles. I would like to call on the dais Mr. Sandeep Nayak, Executive Director and CEO, Centrum Broking Limited. Mr. Nayak is the moderator for the session today. Mr. Nayak has over 2 decades of experience in capital markets, including retail broking, private client services and portfolio management, retail distribution and franchisee development. He has extensive experience in equity trading, investment strategies and derivative trading strategies. In his last assignment, he was the head retail broking and wealth management at HSBC Invest Direct Limited, where he was providing strategic direction to retail broking, NBFCs and wealth management businesses of the company. He's a qualified chartered accountant with an All India first rank and is a multiple gold medalist. He's also a cost accountant with All India first rank. Amongst the panelists, we have with us Mr. Gulzar Malhotra, Chief Operation Officer, Indian Property Advisors, which is IPAL Fund Managers. Mr. Malhotra is a qualified architect from the School of Planning and Architecture, Delhi. He honed his real estate skills at the CB Richard Ellis, gaining valuable experience and proficiency in business development, project coordination, and client management for various investment advisory mandates as an associate director and regional head of the strategic consulting group. During his 4.5-year tenure with Deutsche Bank, Mr. Malhotra closely monitored debt, mezzanine, and equity transactions for assets worth $6 billion across India. Additionally, he gained extensive international experience by virtue of underwriting real estate transactions worth over 800 billion pounds across Europe and APAC. Subsequently, he was employed as the India REIT as the head of the risk management. Mr. Gulzar is currently the CEO of IPAL Fund Managers and is responsible for managing the overall operations of the fund manager, including strategizing new fundraisers, formulating appropriate risk mitigation strategies, and obtaining requisite regulatory approvals, in addition to actively managing the investments of the funds and assisting with fundraising. Thank you for being with us, sir. Amongst the panelists, we have with us Mr. Nipun Mehta, founder and CEO, Blue Ocean Advisors. Mr. Mehta is a fellow member of the Institute of Chartered Accountants of India and a highly distinguished professional of the Indian financial services industry. His experience spans across global and domestic institutions like the Society General and the ILFS Group across private banking and wealth management. He's the founder and CEO of the Blue Ocean Capital Advisors. Mr. Mehta has also played a key role in formulating the regulatory policies for the Indian capital markets by being a part of the advisory committee set up by SEBI, including those like the buyback of shares and derivative margining. He's the author of the best-selling book, OTC Exchange of India. Sir, may I please request you to step onto the dais? We also have with us Mr. Sandeep Parekh, founder, Finsec Law Advisors. Mr. Parekh is the founder of Finsec Law Advisors, a financial sector law firm based in Mumbai. He worked as an executive director at the Securities and Exchange Board of India, where he headed the legal affairs and enforcement departments and has been a faculty at the Indian Institute of Management, Ahmedabad. Mr. Parekh has obtained an LLM, Securities and Financial Regulations degree from the Georgetown University and an LLB degree from the Delhi University. Mr. Parekh has been a member of the Cabinet Secretariat Task Force for measuring performance in ministries and departments of the Government of India. Sir, may I please request you to step onto the dais? I would now pass on to Mr. Nayak and request him to kindly take it forward from here. Thank you.
Thank you, Neha. Necessity is the mother of invention is an oft-repeated saying, and this applies to very aptly for alternative investments. Is very apt in describing the evolution and growth of this space. When the markets from time to time go down and they get into a tailspin and we get into a bear grip, as they're usually prone to, no wealth manager is God. He's only able to show relative returns Typically, a conversation with a client would read like this. Well, the markets are down 30%. I'm down 15. Sir, I've outperformed your portfolio by 15. Will the investor say, great, great son, congratulations, I love you? No way. The conversation would be somewhat like this. Goddamn, you son of a dash, dash, dash. What have you done to my hard-earned money? Ladies and gentlemen, the point I'm trying to make is alternatives try to fulfill a need that traditionals may fail to. They deliver absolute returns and reduce volatility in portfolio returns, leading to lowered risk and overall better portfolio returns. Ladies and gentlemen, welcome to this panel discussion on the ABCs of alternative assets, strategies, and vehicles. I have an eminent group of panelists with me, and we hope that in the next half an hour, we will be able to do justice to this topic that has been chosen. Before we delve into the discussion, let us define what we mean by alternative investments or alternative assets. Arpita, in her previous presentation, touched upon this. A simple definition of alternative investment is anything other than a traditional investment, such as a long position in equities, fixed income, or cash. So simply put it, conventional debt, conventional equity, and cash stay out of alternatives, and the rest falls into this definition of alternatives. The broad classifications are, number one, real assets, real estate, land, REITs, infrastructure investment. Those come into this category. Number two, you have hedge funds, long-short equity funds, and managed futures. Number three, commodities and precious metals such as gold, silver, diamond, palladium, etc. The fourth category would be private equity, typically real estate and unlisted equities. Number five, structured products which are linked to an underlying market index, offering principal protection. Number six, offshore investing. Number seven, currencies. The list can go on. Number eight, I would put it as residual asset class, residual others such as art investing, antiques, coin collection, wine, timber, and what have you. There are plenty of options across the world. What are the objectives of alternative investments? What was the necessity of this invention? Number one, absolute return objective. Traditionals like equities only deliver you a relative return. So if the market is down, your fund manager or your wealth manager is going to tell you, sorry, I haven't made returns for you. Number two, the lower volatility in portfolio returns, since these are very low or moderately correlated to the markets. And number three, they provide diversification in the portfolio and reduce risk. What are the characteristics of alternatives? These may use leverage. Obviously, they have lower liquidity, barring liquid alternatives, which Arpita covered in a presentation, and that's a sector which is growing in a big way. I'll come to that a little later. They have relatively higher fees and include performance fees, typically the 220 structure, and you perform. You make, as an investment manager or as a wealth manager, you make higher returns. Of course, these may come with less transparency. Alternatives are a very, very crucial source of revenue growth for the industry. Typically, you've seen that in traditional actively managed products, there is a constant threat of commoditization and margin pressures. SEBI says you can charge 2.5% brokerage on equities. I'm sure nobody in the industry is even able to charge 0.5%. Fee pressures are unrelenting on the traditional side. Pricing for alternatives is relatively firm. There is a place where you can charge performance and charge performance fees, and as a wealth manager, make higher returns. As per a report by McKinsey titled The $1 Trillion Convergence, the alternative investment space is growing rapidly, and today, last year in 2013, it constituted about 12% of industry assets and 30% of industry revenues. Going forward, by 2020, it's expected that this would constitute almost 15% of industry assets, but more importantly, 40% of industry revenues. So it's no means an area we can ignore, ladies and gentlemen. Investors are getting into this space in a big way, especially HNIs, especially in a space called liquid alternatives. Liquid alternatives are the hedge funds where daily liquidity option is available. And this is turning out to be a significant driver of retail assets under management in the US retail asset management space. And over the next 5 years, it's expected that 50% of net retail revenues would come from this space. Today, liquid alternatives is a $2 trillion industry, growing at a CAGR of last 5 years grew at a CAGR of 12.6%, vis-a-vis traditionals, which grew at around 5.4%, albeit on a larger base. Ladies and gentlemen, friends from the industry, and dear clients, in the traditional world of asset management, there are no category leaders. There are category leaders, whereas in alternatives, there are no category leaders. Performance is the axis of competition. They say size does not matter, performance matters. This is probably a space where David can challenge Goliath. Amongst the traditional asset management industry where traditional fixed income and equities goes, top 5 fund managers contributed almost 50% of the market share. Vis-a-vis that, in the alternative space, the top 5 fund managers control less than 10% of assets. This surely is a space where David can challenge Goliath and overcome him. This space is a win-win both for the industry as well as clients. For industry, there is a pricing advantage, number 1. And number 2, here, size does not matter, performance matters. So obviously, any fund manager worth his salt could challenge Goliath and overcome him too. From a client perspective, returns are absolute returns. Despite paying higher fees and performance fees, he's going to make higher returns. And 2, low volatility in the overall portfolio due to low correlation or no correlation with the markets. So therefore, it is a win-win space for both client and wealth manager. How does one approach alternative investments? In approaching alternative investments, to my mind, one needs to be conservative. Typically, alternatives are built on portfolio manager skills, so obviously it's going to be multi-manager driven portfolio. Investments are to be tailor-made to suit clients, or suitability is an important aspect before we decide on what to actually offer to a high net worth individual. One needs to keep a demonstrated bias towards success already achieved. There are a lot of paper-based theories and back-tested models coming. One needs to be very, very careful on this. Worldwide, the largest investors in this space are the institutional investors, namely pension funds. Wealth managers and family offices are only second in line. Of course, that is a large constituent today. Let me just move to the panels now. Good morning, Nipun. In asset allocation strategies, typically a rule of thumb is that you have investments in equity as 100 minus your age. That's a very common rule of thumb. For an ultra HNI, say, who's 50 years old and who has, say, a 50-50 investment into debt and equity, for argument's sake, let's keep it simple that there is a 50-50 into debt and equity. What should be the approach that an ultra HNI should adopt of asset allocation to alternatives?
Well, good morning, Sandeep. Good morning, everybody. Typically in the HNI space, and we've seen a lot of extremes. So some of us won't be surprised if you see very large allocations, very skewed allocations towards particular asset classes. So it could be traditional asset classes, it could be alternatives. We've come across cases where probably 100% of the total investable surplus is invested only in art. A lot of guys would typically invest probably 100% of their whatever the investments is or asset allocation done only in private equity. In India, typically you see significant allocation having been made typically to your own business, which again is equity. So it needs to be defined in that manner. So you've seen a lot of skew typically happening within the asset allocation space. Also, if you go back maybe 10, 12 years, there was very limited understanding and awareness about asset allocation, at least in India. If a Harshad Mehta invested in equities, a lot of people want to invest in equities. Today, that's different. If a large investor invests in equities, that's not necessarily the best asset class that needs to be invested in. So there's obviously greater awareness that comes about on asset allocation. When you look at the alternative space, obviously there has been very limited allocation that's happened. The allocation is increasing given the fact that there is understanding that there can be risk management as well on the one side. On the other side, you can have more absolute returns as opposed to relative returns. So let's say some of us invest directly, let's say with real estate developers, whatever allocation that might be there. There is now a greater understanding that my ability to obtain collateral from the real estate developers directly is likely to be compromised, and probably it makes more sense to go through a fund manager. Probably it makes sense to manage risk better, where a fund manager is in a far better position to obtain collateral and manage the risk that is there. Probably I part with the fund manager's fees. That reduces my overall return a bit, but at least I'm ensuring that the risk management is proper. So that awareness is ensuring that the alternative space probably starts getting greater and greater allocation. But our sense is that a minimum of 5% is something that an investor and HNI should start with. Our sense is as track record builds within the industry, as the understanding of risk management increases, this allocation will go up to as high as 15 to 20% of the overall portfolio. And obviously, a good part of this needs to come out of the debt allocation, clearly. One needs to understand that this is not equity allocation. When we're talking of absolute returns as opposed to relative returns, this would typically be carved out of the debt allocation that an investor has out of his portfolio.
Nipun, internationally, institutional investors, I'm told, are almost 29-30% on alternatives. So do you think a max of, you put a cap of 25 to 30% for an investor, or is it difficult to put a one-size-fits-all, and it is typically a wealth manager sitting with his client working out the asset allocation? Where do you think the max could be for an investor in this kind of a space?
Well, like I said, there is typically a skew that sometimes happens, but as track record builds in India, and there is a very clear distinction between how this asset class is viewed globally, or let's say a case like US, where the overall mutual fund assets are about $13.2 trillion, while the hedge fund assets, which is hedge funds as well as fund of hedge funds, is close to about 2.8 trillion. So the mutual funds is, let's say, about 4.5 times. While in India, that ratio is probably 2%. The mutual fund industry is 50 times or probably a little more as compared to the hedge fund industry or the alternate space that is there. So obviously the track record is missing, which is ensuring that there is limited allocation that happens. As track record builds, that allocation has to be going up. As you see greater understanding and awareness, again, in India, typically you've seen allocation more coming towards simplistic thinking, simplistic investing. If I want to invest in equities, it's direct equities. It started off like that. People now allocate it to mutual funds. If I want to invest in real estate, I'd rather invest in hardcore physical real estate as opposed to investing in, of course, all the instruments that are there for real estate probably they are coming in only now. But as opposed to a REIT, I would typically rather invest in physical real estate. So there is that simplistic thinking as opposed to the fund space that is there. Our sense is that allocation would increase gradually and significantly.
Okay. Good morning, Sandeep. You are from the legal fraternity. Vehicles have been created in the form of trust, company, LLP. What is a suitable structure to participate in this space? So could you just summarize the pros and cons of each structure, and what is the most convenient vehicle to your mind?
Right. So just before that, I'll just quickly try to, as a lawyer, I'd like to break things into a structured point. In the alternative space, I'll call it three different spaces. One is, of course, outbound alternative space, where you have HNI investors in India who want to invest abroad. maybe buy an island in Greece or invest in mutual funds in the US. That's kind of a fairly underdeveloped market. Then you have the offshore people coming and investing in India. And typically, they don't come with labels. They don't come with all these labels of hedge fund, pension fund. There may be some labels attached to it, but broadly they come through either the foreign portfolio route or the FDI route, depending on what kind of investments they wish to hold. And that is obviously a highly developed market. And this year alone, I think we've had $35 billion of net FPI or foreign portfolio investment inflows. And third is the purely domestic space in which Indian investors wish to invest in the alternative domestic space. And that is captured by the AIF regime, which started, the regulations came in May 2 years back, 2.5 years back exactly. And that's obviously been hugely, it's actually just a drop in the ocean. I mean, just compare it to the $150 billion mutual fund industry in India, and the AIF space is just $3 billion worth of commitment, and just $1 billion worth of actual funds which have been collected, which is, to put it in perspective, it's less than the price of the home of the richest Indian. It's actually a very, very insignificant amount. So it's not really taken off, and I think the biggest blame you can put would be at the door of the CBDT or the tax man, who has created so much of uncertainty. As it was extremely uncertain. 2 months back, they came out with a circular which made it even worse. So coming to your question, sorry for the long-winded answer, but coming to your question, typically there are kind of three structures in the domestic space. You have the company, you have the trust, and you have an LLP. Company is almost ruled out, but out of 120, 130 AIFs, just one person has registered as a company. So that should give you an idea why, not why, but the fact that companies are a disfavored vehicle. And the reason is very simple. Reason is it's difficult, if not impossible, to actually wind up a company in India. So the flexibility which you need of collecting funds and refunding funds just is not available with a company. There are a few LLPs in India. LLPs come with the advantage of more certainty in taxation, but though typically slightly higher kind of percentage in tax compared to a trust. And the trust is the benefit of flexibility. You can raise capital easily. You can wind up overnight virtually. So it's a very, very flexible vehicle for a pooling vehicle, and which is why almost 80 or 85% of all the registrations we have done have been through trusts, and very few through LLPs. We've not done a single company. So I think those are the kind of broad vehicles which are possible.
Thanks, Sandeep. Good morning, Gulzar. As per the research undertaken by CRISIL for a leading wealth management outfit, the real estate private equity funds raised in 2013 were between 5,000 to 6,000 crores INR from HNIs. In 2014 as well, we are seeing a good amount of traction and funds already raised, and launches in the pipeline, including your own ongoing fundraise, appears to garner a similar number, if not more. The fund managers in this space initially went through the equity route, and now we're seeing they seem to be more comfortable adopting a debt route, or some of them even trying hybrid structures of a combination of equity and debt. What's your take on this, Gulzar? What do you advocate as the best investment strategy in this space, equity or debt?
Good morning. I'd like to start off by putting one thing in perspective about the real estate industry per se, which is that it's probably the most misunderstood industry once you're on the outside. Once on the outside, it's the riskiest industry. It's the worst people to deal with. You have developers who are all crooks. You have brokers who are out to fleece you. You have contractors who are not constructing up to the standard, and your house can fall down. I can just go on with the list of things that are all negative when you're on the outside. Now I'd like to put things in perspective from the inside. Okay? Not as a fund manager, but as a real estate developer. I'm a real estate developer. Why would I want to mess up with my own market? Why would I not want to deliver on time? why would I not want to give a quality product, right? So it's not the developers who are trying to mess up. Let's take it from the outside. Is it the industry that's really going wrong, and is it people not making money of the industry? And if I put a general question across this room of people who bought a house in Mumbai and have lost money, I don't think there'll be too many of us who've actually lost money, right? And all of us here are the so-called dumb investors. It's the fund managers who are supposed to be the intelligent people. The reason why I'm putting this in perspective is because you've asked me a question whether it should be debt or equity. And my specific answer to that is that it's not a one-size-fits-all. You cannot have either debt or equity in real estate. Real estate is an industry which has varying risks associated with it at various stages of project development. Ideally, you should be entering into real estate when you have a specific strategy in mind. So when you have a specific strategy in mind and you have a specific product in mind is when you can decide whether you want to look at the debt route or the equity route. As regards us, well, even though you said that a lot of people tried equity and are now looking at debt, my take personally on that is that debt in real estate is still a huge amount of faff. You can actually have the same kind of structure loaded up with a whole lot of paperwork, which is done really well these days. But if I go down to actual execution or actual enforceability of that paperwork, there's hardly any enforceability that exists, which means I have the option of participating in a project with a developer by adopting the equity route and partaking in the upside of a project, but I'm not doing that. I am going rather with the route which is the so-called pure debt, mezz, structured, whatever you may call it, putting in a whole bunch of paperwork of associated collateral, etc., where I have my doubt on the enforceability or the timeline associated with the enforceability, restricting the upside that I have, and I'm actually becoming a burden on the project. So if you want a project to work, or in any of these structures, whether you want to get good returns from debt or equity, the underlying project needs to make money. If you load on a project with 25% coupon debt, it's not going to make money. If the project doesn't make money, you're not going to make money no matter what structure you come in with. So my advice would be that you choose the structure based on the product, based on your investment objective, and based on the strategy that you have, how long are you willing to hold. That would be critical in terms of trying to identify which of the two modes you would go in for. As far as we go, we continue to prefer equity. We continue to prefer equity because we believe that we understand the construction industry. We've come in from the on-ground nuances associated with the industry. We understand the risks. We understand the things that can go wrong. We'd like to be involved at all stages with the developer, monitor it closely, and try and set things right and enjoy equity returns.
Gulzar, I think you've set a very doubt on everybody's mind on debt as a structure by saying the enforceability is in question. Here I'd like to ask you, because I'm sure a lot of people sitting here as clients or as fund managers, wealth managers would have advised investment into real estate paper which is structured as debt, and you saying that enforceability is a question is a little controversial. I know enforceability is tough, but I think it's a matter of time. Can you just elaborate a little more on that? Why do you think enforceability is such a challenge?
Sure. Okay, so to set things right, when I say enforceability is a challenge, the way I look at it, when you're coming in from a debt structure, there are two modes of enforceability in a real estate project. The first is if a developer defaults, you actually step in and take over the project and you complete it, right? For that, you need to have the credibility and the capability to actually complete it.
Or hire somebody who has the capability to complete it.
Yes.
To take over the project and get in the best guy who can finish it.
Absolutely.
Yeah, that's one remedy available to somebody who's got stuck at the wrong end of a real estate paper.
Absolutely.
Yeah, that's
and like I said, that part comes with its own timelines associated with finding an alternate person or a company executing it for you. If you built it into your model, if you've actually thought it through, you've tied up and you have the backup built in, great. That's the first mode that you have. The second mode, and the reason why I again say that from a debt perspective is that you're sitting on collateral. I'm sitting on a 2x collateral or a 3x collateral. A 2x collateral is great on paper. My question is, have you tested the marketability of that collateral? A lot of people who actually invested, a lot of fund managers who invested, and we've gone wrong. The industry has evolved. There's no harm in accepting it that there were things that were not done, which could have been done better. You invested and you had collateral of 3x in terms of a 400-acre land parcel in a tier 3 city. Once the markets turn turtle, try trying to monetize the collateral. So where I'm coming from is, you need to understand the industry. If I'm taking a collateral, how marketable is it? How long will it take for me to actually, get the returns from whatever I'm holding? That's where my concerns are with the debt and the collaterals associated with debt.
Thanks, Gulzar. I hear you, but thankfully there have been delays, but I don't think there have been any defaults in the real estate industry just yet. And we'd hope that with the economic scenario turning around, we probably have avoided any kind of crash in that space, if I may use that word. Thanks, Gulzar. Nipun, I come back to you. If you look at hedge funds have been a phenomenal success in the global markets. They're really what come in the liquid alternative space, where you could even get an exit on a daily basis in a hedge fund, which is in an underlying asset like equities. Long-short strategies have been followed in listed equities, derivatives. There have been quant models using algorithms or much simpler cash future arbitrage strategies. These have been great success overseas. But in India, however, the space still seems to be in an infancy with about 2,000 crore of assets. That's what we saw in the presentation that Arpita presented. There's hardly about 2,200 crores in this space. Why do you think this has failed to take off just yet? And what do you think the future holds for us here?
Well, let me start with your first factual statement, which is in the US, the hedge funds have really taken off. And like I gave the statistics earlier, it's close to about $2.8 trillion of hedge fund assets that are there, which includes hedge funds and fund of hedge funds. Now, clearly there are 3 or 4 reasons why hedge funds have been extremely successful. One is the extent of lack of regulation or limited transparency that is allowed. So obviously a lot of fund managers have tried to collect assets, mobilize assets more through hedge funds. 2, their ability to leverage. 3, their ability to short the market, which probably reduces beta to whatever extent it can, and also raises its ability to give relative return. And clearly 4th is, except for some of these liquid alternatives that are there, typically they don't have the pressure of keeping a lot of cash, like typically a mutual fund would have, and where you need to monitor daily NAVs on the one side, on the other side you need to keep adequate cash to ensure that whatever redemptions are paid out. To that extent, except for the liquid alternative space, typically hedge funds don't have those kind of pressures. Private equity funds probably don't. A lot of that typically is longer term investing that is there. So some specific reasons why hedge funds have really been successful as far as US is concerned. In India, of course, it's just a start. The other point on arbitrage, let's say funds, I entirely wouldn't agree. In India, there has been a lot of simple arbitrage, cash futures arbitrage that's been going on for several years now. There'll be several broking firms which would set up what they call as pairs, and who would do cash futures arbitrage. Earlier, it used to be arbitrage between the NSE and the BSE in terms of differential settlement periods that was there. Even before that, the ALBM and the Badla market that was there. So there have been various forms of arbitrage that has been on in the Indian markets. More recently, it's the cash future arbitrage that is there. And particularly when markets are volatile, your ability to execute that becomes high. So they have been around, not in a formalized market as maybe typically a hedge fund, but more in an informal market that has been around. But when you look at hedge funds, clearly our sense is, like I said, probably lack of track record is something that's holding back a lot of people from wanting to invest. 2, generally there would be a bit of a sort of stigma when you say that these are a lot of trading strategies that are there. When there is a simple long only, let's say an HNI has a mindset of only investing equity long, long only strategy that is there. He doesn't like too much trading happening on his account or too much trading happening in the fund that he's investing. He doesn't understand that as probably the ability of the fund manager to reduce beta, the ability of the fund manager to get higher relative returns, the ability of the fund manager probably to ensure that he can take benefit of the special situations that are there. So some of the broad reasons why hedge funds haven't taken off, they are of course only a very recent entrant as far as Indian markets are concerned. But our sense is that trend has to come in where as 2 or 3 year track records build and there are higher relative returns, like you've seen the acceptance probably of the real estate AIFs that are there or the category 2 funds that are there. The same benefits that that I listed out for what's there as far as US is concerned are likely to be there in India as well. And that's the reason why hedge fund overall corpus has to be growing significantly.
Right.
Can I?
Yeah, Sandeep, I think you should take the legal and taxation angle of these kind of funds.
So let me start with his point really in terms of, the arbitrage industry does exist. The problem is that it exists only for the prop books of the
Prop
broker.
books of brokers.
It exists for the PMS clients in which you cannot pool. As soon as they pool from 2012, as soon as they pool money even from 2 clients, you are obligated to create an AIF which is registered with SEBI. So that's I think the arbitrage market has shifted away from the formal AIF, the alternative space. Leverage is restricted by corporate law, extremely restricted in India. AIF law does not allow more than 2:1 leverage. So these are the kind of the 2 restrictions on leverage. The shorting market exists only in the derivatives. If you try to short the cash segment, it's almost impossible to borrow shares. So
you can't borrow the shares.
That market is itself stunted. And finally, tax. It's besides what I mentioned. Category 3 typically anyway invites the marginal rate of taxation, 32.8% or something. Not just that, but if you're trying to do arbitrage, it will not even be business income. It will be considered as speculative income, which you cannot even set off against business losses. So it's a killer on all sides as far as tax goes.
No, arbitrage also has become very difficult because you have these algo and high-speed systems kind of taking away the arbitrage so quickly that even prop books are struggling nowadays to do the arbitrage. Thanks, Sandeep. Gulzar, I come back to you on the real estate space. We've seen that the asset class has delivered very good returns. You've seen probably fantastic returns in Mumbai, which is the largest real estate market in the country. However, if you go back and see the first set of real estate Ps launched in the years 2005 to 2007, they've not afforded too much joy, despite the asset class itself not disappointing. So where do you think these fund managers erred, and what are the key learnings that help us make a new beginning here?
Sure. Like I said, I think the industry itself is in a phase of evolution. It's not as if we've gone through multiple cycles as far as the real estate and especially the real estate, the PE industry goes. People invested into a number of projects, into a number of developers and into a number of cities, assuming that things would move just one way, which was the first, in my opinion, which was the first oversight. Because no market moves one way. There are all markets and all industries have their downturns. Most of these, investments that were made in the period that you're talking about were into asset classes which included commercial, retail, hospitality, with no real secondary market for purchase of these assets. That itself, was a huge thing that should have been seen when you were entering. REITs, of course, didn't exist. We are still at a stage where they're getting formulated. So secondary market for them was extremely limited. A lot of people ventured into tier 2, tier 3 cities with the general hope being that commercial markets are going to do well. The IT industry is going to pick up and you're going to have exactly the same amount of, the linear growth going on for innumerous years, which was again, and oversight as far as any investment is concerned. That's not how it worked. A lot of these people who went into tier 2, tier 3 cities are facing issues in terms of exits from those locations. The other was the structure itself that was adopted. A lot of the fund managers actually wanted to just deploy assets, which again stems from what a lot of us have been talking about, the 220 model, where they started gaining their money in terms of deployment. Focus was on deployment, not on actual executable projects. And hence they said, okay, you take a cash out, given a particular developer money, he went and purchased another land parcel with the same amount of money. It was all a book building process that was happening. The execution itself is where the lacuna really lay. And this is where skin in the game for developer wasn't there anymore. You invested into a project, you allowed him to take the money out of the project, he would never really focus on that project anymore. That was another learning that really came out of it. The other aspect was on downside protection. And downside protection is something which we just discussed some time back. How monetizable was your collateral? What was your alternate strategy when things went wrong? Okay. A lot of people didn't focus on that, and that's what a lot of people are now realizing now that a lot of these funds are coming to the end of their fund life and are not able to find suitable exit options. And another thing where a lot of funds have over the years improved their capabilities, but at that point of time, the necessary capabilities probably did not exist, was actual asset management, wherein you had quality talent monitoring the underlying asset for you in terms of execution, in terms of day-to-day operations, because like I said, real estate has innumerous risks associated with it. There are various things that can go wrong, but there are things that can be preempted. And a few simple examples I can think of is, there were a number of people who invested, with a 5-year fund horizon, invested into a 200-acre township. Now, anyone who's been in real estate can tell you can't construct a 200-acre township in 5 years and exit from it, no matter what you do. So, you needed to have the capability, you needed to think it through and not just go by an Excel sheet which was prepared, a fancy looking sheet, and it was all Excel sheet based investing. A lot of people invested into hospitality projects saying that, commercial space will take off, and hence Pune, for example, as a market had about 250 rooms at one point of time. That's jumped to about 2,500 rooms. Occupancy errors have dropped. So, it's all reflective on how the markets have panned out.
Thanks, Gulzar. Hope fund managers have learned their lessons, and the next round of funds coming don't repeat those mistakes. Thanks, Gulzar. Sandeep, coming back to you, you've specialized in bringing a lot of the AIFs to ground. There's almost 100 of them plus already registered. Are you noticing any innovation in structuring, and what's the typical kind of AIF? You mentioned that no LLP and companies are coming into the foray, but within the trust space, do you see any innovation in structuring?
So I think there's a lot of innovation. I think just let's keep the tax aspect aside for a second. I think the entire regime of SEBI is very contract oriented, which is to say that so long as you disclose what is there, what you're selling, we'll allow you to do whatever you want. And I'll give you just one or two kind of specific points. One is conflict of interest. And we've done some restructures also through the AIF. And there have been kind of some restrictions because a category 2 AIF cannot invest more than 25% in a single company. And they can only invest in securities and not in real estate. So we've had AIFs which have in turn invested in 4 SPVs which issue securities. And each of those 4 SPVs invest solely in the real estate project. And that we've discussed this with SEBI. SEBI is fine with the structure. So we've done fairly innovative stuff, which broadly, the law of contract applies. If there's a conflict of interest, since the developer is also the fund manager, you essentially disclose the conflict. And again, then that becomes kosher. So long as you have these things in place, the sizes, the minimum sizes were mentioned today morning: 1 crore per investor, 20 crores. For the AIF, so long as you qualify for each of those minimum skin in the game, all those things, you're left to the law of contract, which I think is great, provides you a lot of flexibility, with the exception of leverage, which has been restricted.
Thanks, Sandeep. I think a discussion on alternatives can go on and on, but Neha there is indicating to me that we're running short of time. So let me conclude by asking a quick question to the panelists. We've seen the AIFs have raised about 20,000 crores in the last 2 years in terms of commitments. The last slide the previous speaker showed. Last 2 years has seen 20,000 crores. Can we hazard a guess on what could be the fundraisers and commitment raise that we could have in the next 2 years? Nipun, would you like to hazard a guess on how this burgeoning industry would grow?
Well, I think clearly the industry has to grow significantly. I won't hesitate to say in the next 2 years it should probably more than double in terms of commitment. Probably issues like taxation or ensuring that there is better planned taxation that can come about as far as maybe something like a category 3 is something that can help. More importantly, I think as time passes and as track records build, probably more products need to come in, as an underlying. Today, in hedge fund space, you've got only equities that you can do in terms of the leverage leg of it. There's no commodities you can do. You can't do currencies, bonds. All of these, when you look at the hedge fund space globally, there are innumerable products that are there.
Right, right.
Distressed assets, multi-strategy, special situations. You got emerging markets. You got innumerable strategies that can come about. Today, that's restrictive.
Yeah. So your number would be about 40,000 crores, doubling from where we saw last 2 years. Gulzar, your quick take, do you think it'll cross 50 in the next two? Because you had 317, so it's got to be 20 and 30 next 2 years, 50. Would you take a punt on that crossing 50,000?
Like I said, for the real estate industry, I wouldn't want to go by just the past figures. You have the new category, which is REITs, that's been introduced altogether. That's likely to be a game changer in terms of just the sheer investment that comes in, because if we do have the taxation, etc., related hurdles cleared out, there is a huge secondary market for commercial assets that's lying untapped. So that coupled with the general buoyancy that's witnessed in the market, I don't see any reason why it should not greatly improve from here.
Right, right. Sandeep, do you think the regulator is being too conservative, keeping it 1 crore, and if he brings it down to 25 lakhs as it is for PMS, we could cross 1 lakh crore in the next 2-3 years?
I don't think so. I think 1 crore is fine. I think, again, as I said, if you leave things to the law of contract, it's completely unregulated space, virtually unregulated, so long as you don't commit fraud and you make full disclosures. I think you need to have much higher standards. So I think most people I've spoken to are pretty comfortable with the 1 crore. The biggest issue is, I think, the tax and the fact that you have to pay 32% if you're an Indian, and if you're a foreign fund, you pay 0% tax. I think that really and it's not actually 20,000 crores. It's actually 5,500 crores, which has actually been raised in the last 2.5 years. So there's a huge.
No, I'm including commitments also of the funds that have come in this year.
Yeah. So there's a huge way forward, and I think it's bound to go up so long as we take care of tax.
Thank you, Sandeep. Ladies and gentlemen, the industry is getting bigger, and more importantly, it's a space where, as I said, the underdog, David, can challenge Goliath, and surely exciting times are ahead of us. With this, we conclude our session, ladies and gentlemen, and I throw the floor open for Q&A. Yeah, the gentleman there. Can we have a mic passed on to him, please? We can't hear you. Gulzar, for you.
What kind of precautions do funds need to look at their end before looking at the equity structure? Because it becomes a high-risk game for the investor at the end of the day.
Sure. If I get your question right, you want to know how an investor can actually mitigate risk when you're going in through an equity structure. There, I think the focus needs to be on the capability of the fund manager, the expertise of the fund manager, and the ability of the fund manager to actually mitigate the risk associated with real estate development per se, and not the financial structuring associated with it. Because when you're coming in with an equity structure, you're actually participating directly in the project. You know, you're not playing the financial game on top of a real estate project. Hence, what would be critical is, you know, his ability to understand real estate construction associated with it, the product they're talking about, the markets, his ability to actually take over projects in case required, his ability to come up with alternate structures and you know, exhibited track record in delivering real estate products. I think that would be something which can be a key differentiator as far as an investor is concerned while choosing fund managers. And just to add to that, I don't think there are too many who have the relevant track record.
Hi. My question is also for Gulzar. I just wanted to check with you, how do you see the commercial real estate versus the residential real estate panning out in the next 3 to 5 years? Because that's the span where most of the real estate funds would be looking at. Because right now, there seems to be too much supply on the residential side and probably on the commercial side also. So where is the focus of the funds, and which cities or which places across India do you see this demand supply kind of getting evened out?
I'll take the first part of your question, which is commercial versus residential. Despite what's really reported, you know, in what we go about reading, in most tier 1 cities, I'm talking about tier 1 cities, you won't have a situation of too many completed vacant residential projects, you know, where in either the end user or the investor is not actually bought into it. Unlike commercial projects, there is a huge vacancy in completed commercial projects that's already lying across locations, which is why rentals in these properties have corrected to, you know, 50% of at times of some of these places. Going forward, I see a continued glut as far as commercial real estate is concerned, essentially because there's a huge backlog of inventory. And the reason between, you know, the commercial and the residential is that developers traditionally haven't been able to offload a commercial asset till the time they complete it. So they need to actually take it till there and then test the market out and see, you know, if you have a secondary buyer. And secondary opportunities in the market were restricted so far. REITs would hopefully change that. Residential, that was not the case. You could start selling a product before you actually started construction. Going forward, for the next 2 to 3 years, I see opportunities in both, but of different kinds. Residential would continue to outperform in a number of, you know, specific locations. It is probably not going to be as widespread as it was earlier, that you could just pick up one city and say, okay, everything over here is going to do well. Since all of us are sitting in Mumbai, I can probably take an example of Mumbai. There are parts of the city where I don't see prices appreciating as fast as, you know, others. Maybe Parekh doesn't do as well as some of the extended suburbs because they've been subdued. Parekh prices have already shot up. There are infrastructure constraints. So you need to actually get into those aspects as well. So next 2 to 3 years, pre-leased commercial assets, there is an opportunity because, you know, prices for these assets are pretty much at the replacement value. You're getting it at cost. You have scope for capital appreciation as well as, you know, the rentals, and they all are already leased out. Residential, like I said, in a majority of tier 1 cities, some tier 2 cities like Pune are also, you know, in terms of volumes have been doing well. There was a second part to your question as well, right? You wanted to know about?
This is basically how do you see the situation panning out in the next 3 to 5 years? That's what.
So next 3 to 5 years, I see you know, if markets continue to be buoyant the way that they are, the growth would probably, again, come from a lot of the tier 1 cities because that's where the focus of a lot of developers is. In case things do work, then the spillover can probably go in. But I would you know, restrict myself to the tier 1 cities in the next 3 to 5 years.
Thanks. I have a question for Nipun also. Just wanted
Last
to...
question, guys. Yes, we are running short of time. Last question.
How do you see the interest of institutional investors within India and outside India into the alternative space?
Well, it has to be gradually growing for sure. One clear hesitation amongst all of these institutional investors clearly is the track record that is there. And which is the reason why probably in category 1, where you've seen more of institutional sponsors or promoters, you've seen greater allocation. So of the 70,000 crores commitment, 7,000 crores have typically come there. Within the category 2 and category 3 space, it has to be obviously brand dependent, track record dependent, and that can come only over time. So if you see a bit of asset allocation, a bit of allocation that's come about as far as category 2 real estate funds are concerned, within some of those branded sponsors that are there, there has been a degree of institutional participation. Not significant, but it's actually coming in. The other is, in India today, or when you compare it with, let's say, the US, the larger market, as was shown, pension funds typically is the largest investor that is there. You haven't seen that kind of participation by pension funds. I mean, typically pension funds still are hesitating to invest even in equities. So when you look at the AI space, that's still somewhat a little far-fetched in comparison. But as you see, like I said, a track record, as you see more branded or larger players coming in, the institutional participation has to be significantly increasing.
Thank you, ladies and gentlemen. We'll break the discussion here, and we'll continue informally over the breaks. Thank you.
Thank you, panelists. I would request Mr. Asit Mehta and Mr. Aditya Gadge to kindly come on to the dais and felicitate our esteemed panelists. Can we have a big round of applause, please?